All right, let's talk about one of the biggest, but also one of the quietest shifts happening in the world of finance right now. And it all kicks off with a number that is just, well, it's almost hard to wrap your head around.
$10 trillion. Now, that's not just some clickbait number I pulled from a headline. That's the actual operating scale of BlackRock. And when you have that much capital starting to move, it's not reacting to fear or panic. It's responding to math.
Because that's the real question, isn't it? The one that most of the noise out there is missing. What actually happens when the biggest player on the board looks at the game and decides that the safest spot is no longer where everybody thinks it is?
You're watching Voice on Pages, and this is what we do here. We look at the real economics behind the headlines. So if you're the kind of person who cares more about understanding the actual systems at play and not just the slogans people shout, you should probably go ahead and subscribe.
So first things first, what does it actually mean when a giant firm like BlackRock starts to reposition?
You know, the headlines might want you to think it's capital flight, which is basically a panic-driven stampede for the exits. But that's not what this is. This is risk rebalancing. It's slow, it's strategic, and it's driven by a calculator, not by fear. It's not about ditching the US. It's about recognizing that putting all your eggs in one basket, no matter how strong that basket seems, is just a bad strategy.
Here's a good way to think about it. An airline pilot doesn't just abandon the plane if they hit some turbulence, right? No, they check their instruments, they look at the data, and they find a smoother, safer altitude to fly at. That's exactly what's happening here. This is just BlackRock finding a safer layer of air for $10 trillion.
Okay, so that leads to the really crucial question. Why now? What are those instruments telling them that's causing this shift? Well, it all comes down to some pretty cold, hard numbers. Just take a look at the dashboard here. The U.S. federal deficit is sitting at over 6% of GDP. And the interest payments on the national debt? They're now the second largest federal expense. For a massive asset manager, this isn't a political issue. It's a math problem, a really big one, that makes you question the long-term value of U.S. government debt. And here's the specific kind of risk this creates. It's called duration risk. To put it simply, the longer you agree to lend someone money for a fixed rate, the more you risk that new, higher interest rates are going to make your old deal look terrible. And right now, long-term U.S. bonds are just packed with this stuff.
So, holding the 30-year U.S. bond today, it's kind of like locking in a 30-year fixed mortgage right when you think interest rates are about to get really unstable. What was once the safest, most boring asset in the world, well now, it just means you're locked into a low return while everything else is changing fast. And hey, it's not just about government debt. There's a very similar problem brewing over in the U.S. stock market.
Take a look at this. The incredible performance of the U.S. stock market has been driven by just a handful of giant tech stocks. These magnificent 7 companies now account for a wild 40% of the S&P 500's returns. Now, if you're managing trillions of dollars, that's not a sign of strength. That is a terrifying concentration of risk.
It's really like having a basketball team where just 2 star players are scoring almost all the points. Yeah, it's impressive to watch, but what happens if one of them has an off night, or even worse, gets injured? The entire team could just fall apart. BlackRock's job is to build a portfolio that can win no matter what, not one that depends on a couple of superstars staying healthy. Okay, so if they're trying to de-risk from U.S. government bonds and those concentrated U.S. stocks, where is all this capital actually being repositioned?
The money's flowing toward a few key areas. You've got international stocks for that classic diversification, high-growth emerging markets like India, and then 2 really fascinating ones. Private credit, which is basically lending money where traditional banks are pulling back, and real physical infrastructure like data centers and power grids.
And here's why that makes so much sense. Investing in these private markets, it's like choosing to own the actual toll road instead of just trading shares in a car company. It might be slower, yeah, maybe even a little boring, but it generates steady, predictable cash that isn't swinging up and down with the stock market every single day. At the end of the day, it's a bet on stability, not speculation.
Now, all of this inevitably brings up the big elephant in the room, the US dollar. But, and this is important, the reality here is way more nuanced than all the hype you see online. Look, we are not seeing some dramatic de-dollarization collapse. What we're seeing is a slow, very logical diversification. It's like a brand that's still the biggest and most trusted, but it's no longer the only trusted option on the shelf. Central banks are just reducing their over-reliance on the dollar. This is an evolution into a multi-currency world, not a revolution against the dollar. So, to be absolutely crystal clear here, it is just as important to understand what this big strategic shift is not. This is where we have to separate the signal from all the noise.
First off, this is not a prediction of some American collapse. The US is still an absolute powerhouse of innovation and economics. This is like a company diversifying its suppliers. You're not firing your best one.
Second, like we said at the beginning, this is not panic. It is not capital flight. It is a slow, methodical rebalancing of risk.
And finally, and maybe most importantly, this is not a political statement. It has nothing to do with who is in the White House. This is just what pure, data-driven risk management looks like when you're responsible for $10 trillion. It's just math.
And that, really, brings us right to the core of it all. When you see a move this huge, the real story isn't about what people are afraid of right now. It's about what they see coming years, maybe even decades down the road. It's about foresight.
BlackRock isn't betting against America. It's just acknowledging a more subtle truth, that returns, risk, and frankly, power are just not concentrated in one place anymore. Because in this new global economy, capital isn't loyal to a flag. It's loyal to predictability.
This is Voice on Pages. If you want to keep making sense of the systems behind the slogans, make sure you subscribe. And hey, if you found this explainer valuable, there's a link down in the description where you can buy us a coffee. It really helps support the channel. Thanks for watching.